Excel tutorial, Fama-French 3 factors model. Asset pricing models consist of estimating asset expected return through its expected risk premium linear relationship with factors portfolio's expected risk premiums and macroeconomic factors. This topic is part of investment portfolio analysis with Excel course. Feel free to take a look at course curriculum by clicking link at description box below. This tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please read full tutorial disclaimer at the end of this video. Fama-French 3 factors model consists of estimating asset expected return through its expected risk premium linear relationship with market expected risk premium, size, and investment style factors portfolio's expected returns. Size factor corresponds to long small stocks portfolio and short big stocks portfolio. Investment style factor corresponds to long value stocks portfolio and short growth stocks portfolio. Value corresponds to high book to market stock ratio and growth corresponds to low book to market stock ratio. Book to market stock ratio corresponds to shareholders' equity per share divided by market value per share. For full reference, I recommend that you read Eugene Fama and Kenneth French, Common Risk Factors in the Returns of Stocks and Bonds, published in the Journal of Financial Economics in 1992. As a formula, the expected asset return is equal to the expected risk-free rate of return plus a beta 1 coefficient multiplied by the difference between the expected market return minus the expected risk-free rate of return plus a beta 2 coefficient multiplied by the expected small minus big portfolio return plus a beta 3 coefficient multiplied by the expected high minus low portfolio return. The small minus big portfolio is equal to 1 divided by 3 multiplied by small value plus small neutral plus small growth portfolios minus 1 divided by 3 multiplied by big value plus big neutral plus big growth portfolios. High minus low portfolio is equal to 1 divided by 2 multiplied by small value plus big value portfolio minus 1 divided by 2 multiplied by small growth plus big growth portfolios. Great. So let's go into the Excel file so that we can study Fama-French 3 factors model with greater detail. Perfect. So here we are within Fama-French 3 factors model Excel file. So first we begin within the orange colored Fama-French models data worksheet. So here we have the following 5 columns of data. First of this dates with a monthly frequency from the beginning of 2007, and we select A6 and press Ctrl down arrow on the keyboard, goes all the way to the end of 2016, therefore 10 years of data. So we press Ctrl up arrow, down arrow to go into the beginning of the column. Then at column B we have SPY minus RF, that corresponds to the asset risk premium. In this case the asset as SPY, which corresponds to the ETF investment vehicle, which intends to replicate the Standard & Poor's 500 index. Therefore here we have SPY monthly arithmetic returns minus the corresponding month risk-free rate of return for the asset risk premium. Then at column C we have MKT minus RF, which corresponds to the market risk premium. Therefore we have right here regarding the data, the market portfolio monthly arithmetic returns minus the corresponding month risk-free rate of return for the market risk premium. At column D, we have SMB, which stands for small minus big, and that corresponds to the data for the monthly arithmetic returns of the small minus big portfolio. And last, at column E, we have HML, which stands for high minus low. Therefore, here, regarding the data, we have the monthly arithmetic returns of high minus low portfolio. So in order to perform Fama-French model calculation, we do so through a linear regression. This linear regression has as a dependent or explained variable the asset risk premium, and as independent or explanatory variables all the columns from C to E. So market risk premium, small minus big portfolio, and high minus low portfolio. To perform this regression, we go within Excel to the Data tab, and within the Data tab, Analyze Data Analysis Toolpack, and specifically its regression feature, which is what we have right here within the orange colored Fama-French model regression worksheet. Notice that this regression was done before recording this video tutorial, Therefore, it's already been printed and also it's already been formatted. So specifically here, we have the summary output, Anova from that corresponding regression. And if we scroll down, specifically, we see the corresponding coefficients for that regression. So we begin here within the coefficients with a constant or intercept that corresponds to the asset average realized excess return according to the Fama-French three factors model. Then we have the beta 1, the one related to the market risk premium, beta 2, the one related to the small minus big portfolio, and then beta 3, the one related to the high minus low portfolio. Perfect. So now that we finished studying Fama-French three factors model, let's go back into the slides. And as mentioned previously, this tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please pause the video now so you can read the full tutorial disclaimer. Okay, so with this, we finish this tutorial. Thank you for watching.